Hi all, good afternoon and welcome. I am Ridil Mishra from the Corporate Communication team, and on behalf of CareEdge Ratings, welcome you to our today's discussion on credit quality assessment for first half FY23. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Umesh Revankar, Vice Chairman and MD, Shriram Transport Finance Company Limited. Mr. Deepak Ramachandran, CEO, Athaang Infrastructure Private Limited, who will be joining soon, and Mr. Hiranand Savlani, Chief Financial Officer, Astral Limited. The session will be moderated by Mr. Sachin Gupta, Chief Rating Officer at CareEdge Ratings. We will commence the session with a presentation by Smita Rajpurkar, who is a director at CareEdge, and this will be followed by a panel discussion. After this, we'll be having a Q&A session with the audience at the end of the discussion. In case of any queries, you are please requested to key in your panel. Now, may I invite Smita, please, to make a presentation.
Good afternoon, everyone, and a warm welcome to CareEdge Ratings Webinar on Credit Quality Assessment for the half year ended September 22. In this webinar, we will take you through our assessment of the credit quality of CareEdge Ratings rated portfolio in the first half of the fiscal, which we believe would give an overview of how Indian corporates have performed in these turbulent times. To give you a brief highlight of our today's presentation, the pandemic is now behind us, but the global economy is grappling with turbulence amid geopolitical tensions, financial market volatility, and possibility of recession in major global economies. The Indian economy, however, has seen some green shoots with high-frequency indicators showing mixed signals. Amid this, has corporate India been able to sail through the turbulence steadily? Well, our credit quality assessment for the half year ended September 30th, 2022 shows that India Inc. has indeed been able to sail through this turbulence steadily, and CareEdge Ratings has clocked an all-time high credit ratio, which is the ratio of upgrades to downgrades of 3.74 times. CareEdge Ratings upgraded ratings of 318 entities and downgraded ratings of 85 entities in H1 of FY23. Manufacturing sector's credit ratio has led the overall upswing with a ratio of 4.59. We will delve more on which specific industries contributed to this upswing later in the presentation. Bfsi credit ratio saw a sharp improvement, moving up from 1.24 in H2 FY22 to 4 times in H1 FY23. We expect that government schemes should help in the revival of the capex cycle. Despite the ongoing global headwinds, CareEdge Ratings believes that corporate India has remained steady. While we all know that the global economy is in turbulence, let's just go through some of the key global economic indicators briefly. Global economy is in turbulence. So global economies are struggling with slowing growth, high inflation, and interest rates. The OECD, Organization for Economic Cooperation and Development, has lowered global GDP growth forecast for 2023 to 2.2% from earlier forecast of 2.8%, while retaining the 2022 global growth forecast at 3%. US has recorded 2 subsequent quarters of contraction, that is Q1 and Q2 of the calendar year 2022 in GDP, and has high CPI inflation of around 8%. EU has recorded weak GDP growth of 0.8% in Q2 and is feared to slip into recession given the energy crisis. China's growth has also slowed sharply due to their zero-COVID strategy and crumbling real estate sector. The World Bank has lowered China's GDP growth estimate to 2.8% for 2022. So the global economy is in turbulence and we are in troubled waters. The Indian economy has, however, weathered these global challenges well till now, and we will now take a look at some of the green shoots in the Indian economic environment. India's economy recorded modest GDP growth of 3.8% in Q1 FY23 when compared to pre-pandemic period of Q1 FY20. High-frequency economic indicators like GST collections, e-way bills, PMI, auto sales, and bank credit growth look healthy. We'll cover the details later in the presentation. Exports have, however, been adversely impacted by the global economic slowdown, resulting in widening of India's trade deficit. Consumption in the economy is expected to improve as the economy gathers momentum, but rural demand remains a concern given the uneven distribution of rainfall. Investment in the economy is expected to get a boost from the healthy capex, both by the public and the private sector. CPI inflation rose to 7% in August 2022 after decelerating in the previous 3 months. We expect CPI inflation to inch below 6% by the end of the fiscal year. High food inflation and volatile commodity prices pose a challenge for domestic inflation. In the midst of the global turmoil, India is relatively better placed, with our GDP growth estimates of 6.8 to 7% for the ongoing fiscal. Let's now see how India's high-frequency economic indicators that we talked about earlier have performed. The top left chart on Purchasing Managers Index, that is PMI, for manufacturing and services shows gradual improvement in the expansionary zone, that is the above 50 levels. The chart on GST collections shows that collections have been robust, with average monthly collections of over 1.4 lakh crore continuously for the past 7 months. The GST collections have in fact surpassed the pre-pandemic levels too. Bank credit growth chart in the bottom left shows credit offtake marching upwards, registering a robust growth of 16.2% year-on-year in the fortnight ended September 9, 2022, nearly the highest growth in the last 9 years. The capex chart to the right also shows that capital expenditure has shown growth over the years. Further, other economic indicators like auto sales, e-way bill collections, imports have also shown improvement. On the other hand, exports and unemployment statistics are weakening. In the backdrop of the green shoots seen in the Indian economy, India Inc. has proved resilient with its deleveraging efforts over a long-term horizon, which has helped to tide through the global headwinds steadily. Deleveraging has been one of the reasons for upgrades in many of our rated companies. So, to see whether this extends to a large sample of companies, we collated the available data on top 1,000 companies by market cap for the last 10 years and arrived at a median gearing ratio, that is total debt to equity of these companies, and the median gearing ratio clearly shows an improving trend over the last 10 years, with the median gearing strengthening from 0.65 times in March 13 to 0.29 times in March 22. We believe that the leaner balance sheets will allow corporate India to invest towards further growth capital. We now move to our credit quality assessment for the half year ended September 22. The chart shows the trend of CareEdge Ratings credit ratio, that is the ratio of upgrades to downgrades over the last 10 years. We calculate credit ratio on a half yearly basis. A ratio higher than unity denotes more upgrades than downgrades. An increase in ratio as compared to the previous periods denotes an improvement in the credit quality of rated entities and vice versa. With the onslaught of the pandemic, the credit ratio was low at 0.59 in H1 FY21, but showed a steep recovery since then, riding on the positive sentiment with a broad-based recovery across sectors post the pandemic, pent-up domestic demand, and significant deleveraging. The jump in the overall credit ratio in H1 FY23 can be attributed mainly to the manufacturing services and the BFSI sectors. We will now deep dive into the build-up of the all-time high credit ratio. The credit ratio, as we discussed earlier, is at its all-time high for both investment grade and below investment grade entities, with a credit ratio of investment grade entities at 3.9 and that for below investment grade entities at 3.54. Investment grade entities are entities that are enjoying ratings of CARE BBB- and better, while below investment grade entities have ratings of CARE BB+ and below. Now we move to rating category-wise credit ratio. We can see in this slide that the upgrades are significantly higher than downgrades across rating categories, except in the C category ratings, where the rated universe of entities is very low. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. It is clear that the percentage of upgrades to the total rating actions has inched up slightly to 19% in September 22 from 18% in the previous 2 half years. However, the percentage of downgrades has reduced from 9% in H1 FY22 to 7% in H2 FY22 and further down to 5% in the latest half year. So essentially, the key takeaway is that the lowest ever percentage of downgrades with an increase in delta between the upgrades and downgrades has contributed to the all-time high credit ratio in the latest September half year. Now we'll move on to the sectoral trends in credit ratio. We see that there is a broad-based uptick across sectors in H1 FY23, driven mainly by the manufacturing services and BFSI sectors. Manufacturing services credit ratio has moved up from 2.69 in H2 of the last fiscal to 4.59 in the September 22 half year. The BFSI sector has witnessed the sharpest uphill in credit ratio, moving up from 1.24 in H2 FY22 to 4 times in H1 FY23, riding on NBFC upgrades. Infrastructure has, however, seen some moderation in credit ratio from a high of 3.17 in H2 FY22 to 2.24 in H1 FY23. However, upgrades still significantly outnumbered downgrades, even in the infra sector. Let's now understand the reasons for upgrades in these individual sectors, our outlook, and some key monitorables on the credit side. Starting with manufacturing services sector. So we see that manufacturing services sector has demonstrated a resilient credit quality, with the credit ratio moving up in the last 4 half years, with the steepest movement in H1 FY23 from 2.69 to 4.59. The bar chart shows percentage of rating actions in the last 3 half years. In H1 FY23, we saw upgrades in 20% of the cases reviewed and downgrades in only 4% of the cases, while 76% of cases were reaffirmed. The upgrades in manufacturing services were mainly on the back of deleveraging of balance sheets, growth in domestic demand, China Plus One strategy adopted by some countries, and support from government initiatives like production-linked incentives, that is PLI, and Atmanirbhar Bharat. If we look at the industry-wise trends in the rating actions, we see that majority of the upgrades were contributed by sectors such as healthcare, steel, auto and auto ancillaries, textiles, chemicals, pharma, and real estate. Our overall outlook on manufacturing companies remains stable. The uptrend in the credit quality is expected to continue in some sectors like auto and auto ancillaries, chemicals, and healthcare due to high demand in the economy, improvement in profitability in H2 FY23 after moderation in H1 FY23, and significant deleveraging by India. Government spending on infrastructure and schemes such as PLI and National Infrastructure Pipeline and China Plus One strategy would continue to aid India. The key monitorables that we see are impact of the Russia-Ukraine crisis, recessionary trends in the US and EU, China slowdown, inflationary pressures, and rising interest rates. Moving on to BFSI. We see that BFSI credit ratio saw the sharpest improvement across sectors, moving up from 1.24 in H2 FY22 to 4 times in H1 FY23, with significant upgrades in NBFCs and HFCs. The key identifiable drivers towards the sharp movement are proven resilience in business and asset quality amid waning of the pandemic-led fear of slow collections, and this is especially for NBFCs funding mortgages and other secured assets, significant fund infusion, and scaling up of operations and asset base supported by liquidity and restricted leverage. The credit outlook for banks and NBFCs is expected to be stable with scaling up of operations. The banking sector has also seen a significant turnaround with cleaning up of balance sheets after years of credit quality issues post the asset quality review, that is AQR. The gross NPA figures are likely to move to 5% or lower and move towards the pre-AQR figure of 4%. This has improved profitability of almost all banks. Overall, NBFCs and HFCs are expected to drive the growth in the BFSI sector with improved access to equity and bank funding. The key credit monitorables continue to be the ability to access debt funding and rising interest rates. Moving on to infrastructure. Credit ratio for infrastructure continues to be upbeat at 2.24, with upgrades far outnumbering downgrades, though with a slight moderation from the previous half year. The percentage of upgrades in infra have slightly moderated to 19% from 22% of the rated reviews in the sector. Roads and renewables are the front runners in upgrades, followed by EPC segment. The key reasons for upgrades in infra have been commissioning of projects, especially in the road HAM segment and solar power generation space, benefits of Atmanirbhar Bharat scheme providing a fillip to operating companies, enhanced pace of execution along with stronger order inflows, operational projects, especially in the toll roads and port segments, recording robust revenue performance with opening up of the economy, and refinancing of projects at better financing terms and structured financing avenues like InvITs. If we see the performance of the subsegments of infra, we see that roads and power sector led the credit ratio for infrastructure. Construction sector saw upgrades in 19% of the reviews, but also had downgrades in 12% cases. The outlook on the infra space is also stable, with continued healthy collection expected from Genco selling on merchant basis. Imported coal prices are expected to remain high amid global uncertainties. Tariffs for renewables are expected to rise, but shall remain competitive. Revenue visibility is enhanced with infrastructure push by the government, with transportation segment expected to drive growth in awards. EPC margins are expected to recover from FY22 levels with addition of orders at new rates and reduction in commodity prices from their peak levels. However, rising interest rates may impact the bottom line. With this, we have covered the sectoral trends as well. For further details on each subsector, please refer to our full report, which will be released on our website soon after the webinar. I will now sum up our views. So corporate India has indeed sailed steadily through the turbulent waters. Indian corporates have shown strong resilience towards the economic headwinds with an all-time high credit ratio in H1 FY23. With deleveraging of balance sheets and growth in domestic demand supported by government initiatives, we expect the credit outlook to be stable going forward. In this backdrop, CareEdge Ratings expects the credit ratio to remain strong in the medium term, with key credit monitorables being impact of the Russia-Ukraine crisis, global economic meltdown, volatility in commodity prices, inflationary pressures, and rising interest rates. So that is it from our side. Thank you so much. We will now hear from our eminent guest speakers and understand their views on how they see the performance of various sectors amid the economic headwinds. Handing over to Mridul.
Thank you, Smita. Now, may I invite Mr. Sachin Gupta to take over the session, please. Sachin is the Chief Rating Officer and Executive Director at Care Ratings Limited and has over 22 years of experience in leadership positions across the credit rating business. Prior to joining Care Ratings, he worked as Senior Director at CRISIL and managed the corporate and infrastructure ratings. Over to you, sir.
Yeah, hi. Am I visible, Mridul?
Yes, sir. Very much.
Okay, great. Thanks. A very warm welcome to all our panelists. We have with us Mr. Umesh Revankar, Mr. Deepak Rahman and Mr. Hiranand Savlani. Before we start, I will just do a quick introduction of our panelists. So I'll start with Mr. Revankar. Mr. Umesh Revankar is the Vice Chairman and MD of Shriram Transport Finance. He holds a bachelor's degree in business management from Bangalore University and MBA in finance. He has attended the advanced management program at Harvard Business School. Mr. Revankar started his career with Shriram Group as an executive trainee in the year 1987. And ever since then, for the last 35 years, he's been there and he possesses extensive experience in the financial services industry. During his stint with the Shriram Group, he has shouldered various responsibilities and worked in several key roles of business operation. Currently, he's the Vice Chairman and he's also a director in other group companies. A very warm welcome, Mr. Revankar.
Thank you.
Then we have with us Mr. Deepak Ramachandran. He joined Athaang Infrastructure in August 2021 as the CEO. He has more than 25 years of experience in leading financial institutions and banks and asset management companies. Prior to joining Athaang, Mr. Deepak was the CEO of Peak Infrastructure, managing a portfolio of multiple road concessions. Mr. Ramachandran has worked with leading banks like IDFC, ICICI Bank, and IDBI, primarily in the infrastructure space. He has done his graduation from Bfsi and he holds a post-graduation diploma from IIM Calcutta. A very warm welcome, Mr. Ramachandran. Then we have with us Mr. Hiranand Savlani. He is the Chief Financial Officer of Astral Limited. He is a finance professional with more than 26 years of experience and he holds a graduate degree in commerce from HL College of Commerce, Gujarat. Along with being a company secretary, cost and works accountant and gold medalist, as well as an All India rank holder in chartered accountancy. He also holds an LLB degree from the University of Gujarat. His experience in the field of finance is diverse and wide, which includes various areas like financial planning, insurance, global taxation, investor relations, mergers and acquisitions, and statutory compliances. So once again, a very warm welcome, all the panelists. It's quite interesting times, if we, see how India is behaving and how the kind of global commentary that we are seeing, and I'm sure all of you are, kind of seeing that thing as well. And which is what in a way comes out in our presentation that, while there is a global turbulence, the Indian story kind of seems quite stable, and which is kind of indicated by the reasonable, I wouldn't say reasonable, actually quite a sharp uptake in the credit ratio, and it's nearly 3.74 times, which means, for every one downgrade, we are doing 4 upgrades. So in today's panel, we will just try and get into a bit more details about what really is driving it, because while the credit ratio is a more of a top-down kind of an approach. I think this session will help us understand from a bottoms-up level, how are the various industry stalwarts seeing this performance. So let me start with Mr. Umesh Revankar. Sir, one of the reasons why the ratings in a way were, and I'm saying especially for NBFCs, there was a concern, especially during the lockdown and even subsequently, on the collection efficiency thing. Because as it is, the sector had been facing some challenges in earlier years, and now with the things like lockdown, things like moratoriums being given, and then there was some restructuring being allowed, and then ECLGs. There were lot of moving parts, and in that sense, for analysts and for industry watchers, it was a little difficult to really understand, how exactly the asset quality is moving. But now when we look at it, you would kind of also agree that, that seems to be behind us, and now there is a clearer picture emerging in a way. So what I would request your views on is to how you see, collection efficiency for the NBFC space, looking at as of now and your view going forward.
Yeah, thank you. As you rightly put it, in the initial phase of lockdown in the COVID, the collections were challenging. But being transporters of essential goods, most of the transportation industry bounced back very quickly, especially last mile transportation, where the essential transportation was required. But as the industry opened up, every segment in the transportation activity, passenger, everything improved in the last 2 years, and especially in the last 9 months, I should say, post last October onwards, nearly 1 year now, the situation has been very good because all the activities, major activities, like one is the real estate, infrastructure. These are the two major activities that will create a lot of employment and a lot of new businesses. And it also generates a lot of cash down the line because employment is created. And that really helped. And the government support for the infrastructure, new projects in urban and rural also have helped a lot. Apart from that, various other industries, including the consumption industry, because as in India we start celebrating the festivals, the marriages, the events, functions, the demand for these activities have been consistent over the last 12 months, especially only for the 15 to 30 days when this Omicron was spreading and there was some concern. Only for those days, it was lulled. But beyond that, what I observed, every other the segment has been improving, and the consumption and the spending, everything has doubled up virtually over the COVID time, and that has helped. So NBFCs normally lend to the various asset acquisition or the various SME activities. It is basically linked to the consumption pattern. As consumption improves, as the activity improves, automatically the collections and the demand for the credit both will improve. And last 6 months have been substantially good, I should say, and mainly because the demand from all sides has improved. And for the NBFCs which are lending to the vehicles and the equipment, it has been a double benefit, mainly because the cost of acquisition of new assets have been very expensive for various reasons. Was steel price going up, then earlier the Euro 6 implementation. So underlying asset also value increased. When the value of the underlying asset improves, automatically your asset quality will be much better. Even the chances of the non-payment will come down significantly because the underlying asset quality is much higher. And definitely the cash flow with the consumption improving, there has been very good repayment. There's absolutely no concern on the challenges on repayment now. And the credit demand is also improving, because even in the rural area, we have witnessed, even during the COVID, we had a positive GDP growth in the rural area because the monsoon has been consistent. And because of that, we are able to control the inflation by and large. Of course, the government intervention in the both controlling wheat and rice export and some export tax on the steel, all those things have helped. The government intervention has helped in controlling the inflation, and thereby ability to consume and consumption has been quite good. So overall, I feel we are in a very good economic cycle, and we expect this to continue because everything looks quite positive even from today. And monsoon being good this year, even some places where the rainfall was deficient, like UP and Bihar, there also last 1 month we have seen sufficient rainfall, and that should augur well for winter crop. So I think we are in a much healthier and better position as far as the economic activities are concerned, and that's helping the NBFC to do well.
Got it, sir. Got it. Quite an encouraging point of view, sir. Let me get Mr. Deepak Ramachandran in from Athaang Infra. Sir, infrastructure sector, if I were to focus on, it was quite, I think, benefited from the benign interest rate scenario. And during the COVID also, it did not really have as much of an impact as maybe say, or at least it was not fearing to have as much impact as something like what maybe NBFCs and some other more directly impacted sectors were. So, but now interest rates are on an upswing, across the globe. That is the case. India may be following, but no one is really doubting the rates, are likely to go up a little further. In that backdrop, do you see that the global capital, which was, driving quite a bit of equity transactions and even otherwise, could that be a challenge that India infra story may be affected because now, the global private equity funds or other sovereign funds may not invest as much in the Indian infra story as they were expected to do before? Over to you, sir.
Yeah, thanks, Sachin, for that, and also for the presentation, which actually captured quite a bit. I did join a bit late, but I saw the last part of it, which is really encouraging. See, coming to infra, the good part of infra is not, that way from a demand this perspective. As we look at it, it's not so dependent upon external factors, and therefore you don't have the wild swings which you can have in, for example, in the consumer space kind of thing. So that's the good part of the infra. Yes, there is a lot of capex. There is a lot of debt sitting on it. There is a lot of equity requirements, but you have steady stream cash flows. And when you look at steady stream cash flows, that's again, what has been driving many of those equity investments in Indian infra has been actually this aspect of this, steady stream cash flows, which is quite resistant to, various other challenges which can happen. So so people can sort of assume that you're getting this predictable cash flows, and that's what people are investing in. So, and that type of capital, whichever is there across the world, will continue to look for such assets. Yes, what's happening today will have an impact, but completely from a different perspective, because with the rising interest rate scenarios across a lot of people, what's essentially happening is the cost of capital is going up. So maybe 1 or 2 years back during COVID times, when the cost of capital was really suppressed, your expected equity returns would have been X%. Today, you are going to look at X plus 2%. But that amount of capital is going to be there. And that amount of capital is also going to look at these assets, which again are, I would call it, it's not like you have infinite of such assets available. 100 assets were available sometime back, 100 assets will be available even now. It's not the number of assets are changing. The capital is going to remain same, but the expected returns have gone up. So in a way, you could see adjustments in valuation happening. But in terms of fund flow and overall, transactions happening, I'm not I don't think that's going to be very badly impacted. Yes, there will be valuation issues between the two parties, because one party's cost of capital has now gone up, but that's something I think the market as a whole typically has adjusted itself to that. So that's one aspect which I'd like to think. Second part, throughout, and this I've seen, right, and I've been looking, my infrastructure transactions have been happening for quite some time. I've never come across a situation where properly structured projects that has always attracted capital. I think you take care of the project structuring and make sure that that has the ability to withstand shocks. You are through. You will get capital. So I don't, that's not something which is going to impact going forward, given what all is happening globally. And I think globally what's happening, this is something which we have to now assume is something for at least medium term, it's going to be very, very volatile. And but despite that, fund flow, etc., will keep coming in. And infra as an asset class provides that sort of resilience against volatility, and I think that will continue to remain as the sort of something which attracts capital, especially the patient capital which is looking at steady stream cash flows. Yes, if someone is having capital which is looking at high risk, high return kind of things, then anyway, that's not the type of capital infra is attracting. Infra just gives steady state returns. We are not going to get sudden jump up in terms of your profitability or anything. It's going to be what it is. But having said that, there's one caveat which we need to be aware of. And while we are talking today of the global scenario, thanks to the war which is currently happening. But one thing which we need to keep a close attention on is how does this impact all the major economies of the world? Because if that is going to get some of these global economies are going to face challenges, and as we speak, we are seeing a lot of things happening in many countries. So that's something to keep a lookout for, because if some of the major economies start stumbling, then we have to revisit a lot of things again, because then people are going to get jittery, and when they get jittery, they typically they typically go to a safe haven, which today is a US dollar. So we have to see how the movement happens there. But assuming things at least there aren't any very large shocks which comes in. As far as India infra is concerned, I think capital will continue to flow. Valuation could be an.
Got it. So I think what really I'm kind of understanding is that you're saying that while the high interest rates per se may not really be a deal breaker, but yes, if the situation goes a little out of control and people are just just want to be invested in absolute safe currencies or safe assets, then in that situation, yes, they could win. But we are not yet reaching that stage. That's a fair point. Let me get Mr. Savlani into the conversation. He's the CFO at Astral Limited. Now, sir, your product in some ways is a crude derivative. So I would like to, and crude is the one, if you were to see the most direct impact of the geopolitical this thing was on crude. Now, do you see that, now again, while the crude prices have come down, but there is still, OPEC kind of making noises that, they will kind of further reduce the production and all that. So how do you see the crude oil linked industries in India? They are likely to fare considering this volatility in the oil prices. Have you kind of now reset? Has the market reset at say $90 or so of crude, or you still feel that there could be major ups and downs going forward? Over to you, sir.
Thank you, Mr. Sachin, for inviting. I think crude is very, very difficult to predict because of the current situation on the ground. It is very, very difficult. It's so volatile that sometimes it goes very low and then all of a sudden it is jumping. So very, very difficult to predict on the crude. But looking to the way globe across the board has started increasing the rate, it gives the signal that sooner or later, the western part of the globe will start getting the recession. So that is going to lead the crude price under control. It may not come down immediately because of the production cut or many other region, maybe Ukraine-Russia war or all these things. But it looks that it will kept at $9,500 kind of range. It will not go above to that level unless something abnormal thing may happen and then situation may worse. So it looks that crude sooner or later is going to top up and ultimately it is going to come down. But one thing we have to also clearly observe that the winter season is still not started in the western part of the globe where the consumption is very high. So we have to closely monitor how this session is going to be there. If the winter consumption is not going to come down and the demand will be similar to what current level of demand is there, then in that case it may go up also. So we have to closely monitor how the situation will be there, and based on that we have to see how the situation will be there. Now, as far as our industry is concerned, all the petroleum linked products are concerned, I think substantial drop has already taken place because our PVC price, which went up to as high as 160 rupees a kg, and now it has come down to almost 84 rupees a kg. It's almost half than the peak level. Though the crude has not come down so sharply low, but because of the demand scenario globally, which has sharply fallen, and particularly zero COVID policy of China, which has forced the commodity to come down substantially. And that is going to help our industry, particularly the pipe industry, in a big way. Now, coming to the other building material category, because only pipe is not going to serve the building material industry. We have to see how the other commodities are going to spare out. If the other commodity will fall sharp, then I think India will not be having any challenge. Because if the commodity price will fall down substantially, then the construction demand will be high. Interest rate 1% here and then, I think India is used to work in that environment. We have seen 8% GSEC for so many years. So I don't think that is going to affect too much to the industry, construction industry particularly. But if the commodity price will fall, then that is going to help the industry in a big way. And the construction demand will be very, very robust, I can say. And secondly, if you see the last few years number, particularly the COVID period number, the inventories were very, very high. But now the ready inventory has substantially dropped. So that is also indicating that the sooner or later the construction demand has to pick up, and that will be very fast. If the commodity will fall very sharp, then it will be even more sharper, the demand. So we are expecting that if the commodity will fall, then this will be the really good thing. And secondly, last couple of years, government spending on this infrastructure activity and was very, very low. So now with this kind of collection which government of India is getting, it looks that the government will also sizably spend for the infrastructure. And that is also going to support the industry. So overall, I think crude is not going to affect too much if it is going to remain range bound between 80 to 90 kind of dollar. But if it is going to breach that zone and go 100 or maybe above that, then there will be a problem. But rather than crude, if the other commodity fall, that is good for our economy.
Got it, sir, got it. And you're right, so commodity prices have kind of really crossed all boundaries. Now they are kind of softening. Many of them have already softened, crude being one, but even otherwise a lot of other commodities. Let me come to Mr. Revankar, and I saw him smiling when Mr. Savlani was giving quite a positive view on the construction sector, because all of them have to be transported by trucks, I guess. So in that sense, it's a positive thing. My question is on the other side, moving from the asset side to the liability. Yes, so there is certainly the Q1 numbers indicate quite strong demand. I think NBFCs anyways were going a little slow in the last 2 years, for various reasons. And now there is both a demand and there is appetite of NBFCs to lend more, and therefore we can see that traction really there across NBFCs. Do you see, and now if I couple this with rising interest rate scenario, do you see any challenge from a liability side in terms of raising funding for these assets that you will be financing? So is there a challenge? Are you seeing any challenge? Because we've seen credit demand growth that happened, but say for NBFCs in particular, do you see a challenge?
The way a market is playing now, what I feel is the interest rate, whatever increase happened in the last 4 or 5 months, repo rate increase by RBI and subsequent banks lending rate going up, it is not really substantial, and we are able to pass it on to the customers. As long as you are able to pass on to the customer, and as long as the economic activity keeps going up, then people would be able to pay comfortably. Because imagine if the economic activity is still good, and if they're able to pass it on, pass the increased rate to the end consumer, then everyone would be able to pass it on, and that is the happy situation. But the resource being not available or illiquidity situation, that is something which is difficult to imagine now, because right now the liquidity seems to be quite good. Even though credit growth is good, the liquidity, there is not much of a challenge as of now. All the markets are playing well, banks are able to lend. So there is a reason because we are all intermediaries. As long as the liquidity is there, it gets passed on to the borrower. But challenge is the two challenges. One is on the total, how long this liquidity will continue to remain strong. And the second, the interest rate, how much it can go up, and what is when the consumption comes down. Because if the inflation goes up because of this, and if the consumption comes down, then definitely then ability to absorb the interest rate increase will come down. So it is not easy to find a answer for the same. But I feel next 2 quarters, it doesn't seem to be big surprises. But there could be some surprises by end of this financial year if the ongoing situation continues at the global level, because these things can get into the country, imported into the country, and can have some challenge. I'm not very sure about that, but at least for next 2 quarters, I don't really see a huge challenge, because economic activity and consumption both seems to be quite good.
Got it, sir. Coming to Mr. Ramachandran, Mr. Savlani had spoken about, I think, more of a wish or maybe a prediction that the commodity prices, if they were to come down, it will be beneficial. The thing is, if I look at infra space, while we spoke about interest rates kind of going up, generally infra companies are debt heavy, so that certainly has an impact. And then there is, the steel prices were up now, obviously they've softened, and even cement was up now, again, that is also softened. But at the current, and then there were solar panels, I think, which they have not softened to the best of my knowledge, they continue to remain high. Are you seeing, and Indian infra, if you see, say HAM or, even solar and other things, it's reasonably competitive, right? I mean, a lot of 10, 12, 15 bidders are there for each asset and all that, and then they bid and maybe they can get aggressive. Do you see that as a risk building in the system? When suddenly if your interest rates go up, your commodity prices go up, and then you have, funded a project quite competitively, and in that case, because infra is kind of a bad word, we've seen multiple cycles, and it was going pretty well in the last 2-3 years. And with you as a veteran, I would like to hear your thoughts on this. Are we seeing any risk kind of building up? And maybe if you can restrict it to, say, roads, let's say largely HAM, and say renewables, which are pretty much the two sectors which are attracting capital. Over to you.
Okay. So let me start with roads, right? That's the thing. And if you look at it, maybe for the last 6-7 years, it's been predominantly HAM, right? As far as you either had EPC or HAM. And while there are HAM is something where the private sector comes in as a concessionaire and everything. At least the rising interest rate, the way HAM is structured, I think it's a pass through. Frankly, they are not really. You get an immediate pass through because already going forward, whatever annuity payouts happen will happen with the revised repo rate. So that's an immediate pass through. But from a commodity prices, that's something which it's a different ball game altogether, right? When prices go up, you do have your input cost going up in parallel, and when prices come down, it comes with a lag. And here I'll just draw the line to for example, how the home loan scenario worked out because when bank loan worked out, because when the interest rates come down, they come down gradually, but when it goes up in one shot. So it's going to be some time before, infra players start getting the benefit of the softening of the commodity prices. Because as we speak recently, even very recently, while oil has been going down over the last few the bitumen prices were increased. So there is a dichotomy there, but I see over a period, yes, it will normalize and become okay. But from a HAM perspective, again, so this is in terms of the pricing. But in terms of bidding and the way the projects are structured, thankfully, I think NHAI has changed, especially with the O&M cost, because that was actually becoming a sort of a problem going forward with people quoting, I would call it something which might not be possible, because to emerge as a better bidder. But now with NHAI fixing a certain amount and you bidding only the capex, that play around has gone off, and that according to me is a big positive, because otherwise you would have had a runner risk where you would have seen a lot of projects coming in which, say, 5 or 10 years down the line, would not have money to meet the O&M cost. So that's a very good move from to fix the O&M cost, because see, it's as a country, we have always traditionally been very good at building assets, but maintaining that asset has always been a challenge. And I think O&M is something where no compromise should be made, because the moment you don't maintain it, whatever be the asset, doesn't matter, right? It's not just a question of road or any asset you don't maintain, it's just going to deteriorate, and your then cost of reconstruction is going to be exponentially higher. So that's a very good move overall, which has happened. As I said, the interest cost, there is a thing. Even in the commodity prices, because of the adjustment, at least in the HAM projects, because of the adjustments about the WPI, etc., that's been...
There is a natural hedge in some ways.
Yeah, there is some ways. Okay, you may not get 100%, but right, you will still get 60-70% of your cost increases. And when something really abnormally goes up, because it's an industry-wide issue, I would think any government or thing will be much more receptive to come up with solutions to manage that problem. So that's also very much within control, as long as the private sector doesn't go the same way as they did in the early 2010s, when they start bidding abnormally ridiculous numbers.
So you're not seeing that yet, the aggression in bidding?
I think it just started happening.
Yeah, smaller projects. Yeah,
it especially thing, and that's why thankfully NHAI and Ministry immediately intervened and fixed O&M last time, brought only the capex part happening.
So that is where my concern was, because if the projects are bid aggressively and then suddenly after that you would have done your estimation basis some cost on interest and material, and then that goes up. And if you don't have a balance sheet to support it, that's when the
you will have a problem. And some of those projects which got bid out over the last 2 years before this change happened, right, I keep a close watch on them to make sure that's not getting unduly impacted. Because it's one or two issues going wrong, most of these projects have the flexibility or the cover to manage it. But you combine that with another 3-4 things going wrong, that's when the tipping point happens. So it's good, at least, certain tipping points have been closed out. Those things closing out, I would say, is a good, because finally, this cost will come back to the lenders and authority, right? It's better that the authority and lenders immediately, put a stop to it.
Got it. Perfect. Thanks. Let me, get to Mr. Savlani. If we compare Indian economy and the global, one of the biggest reasons, I would say really primarily the only reason which is kind of differentiating us in some ways, giving us confidence, is on the demand side. We still believe that the domestic demand is strong, even though the inflation has inched up here as well as it has in the developed economy, but maybe we are still positive on the demand being kind of sustained, and which is what Mr. Revankar also mentioned. So how do you see that? At what level do you see that the demand will start getting impacted, since in your industry you are ultimately supplying to end consumer pipes and otherwise who are like real estate and other individual home builders as well. So are you seeing that impact happening in terms of inflation reducing the demand, or what? Sir, you are on mute.
I think the demand is still okay. We can't say it is a robust, but still I can say it is a okay. if you can talk to any developer in a city like Mumbai and you ask the 4 BHK bedroom apartment, it is still not available. So demand is still there. We cannot say that the demand is not there. But the only challenge is that when the sentiment is not that great, then everybody work in a pessimism. So I think we have to crack that part. Otherwise, I don't see any problem in the demand. And the way the unit inventory has substantially reduced, that clearly indicates that the demand is there. If you see the last 3-4 days communication across the state, the demand for the real estate is excellent. Not good, but it is excellent. And you pick up any newspaper of Sunday and you see the front page, I think across the board, the real estate news launch are being announced, whether it is a Mumbai city or whether it is Ahmedabad city, everywhere the new launches are taking place in a sizable quantity. So that clearly indicates that the demand is there. Without that, how the developers are going to launch these many schemes? So the demand is still there. It is not there. But the only thing is that the momentum will still pick up once this, to some extent, commodity price will fall further. Second round of fall will be there. That will push. And somewhere interest rate will start picking up. Then I think the confidence level will be back, and then the demand will start picking up in a better way, I can say. Today also it is there, but it's not that robust, I can say. So we are of the view that the demand undercurrent is good, and going forward it should be good only, unless there is something goes wrong and the prices goes up further from here on, like inflation goes up from here on. It looks that now almost peak has been there in the inflation, but now it is very difficult to say what is going to be there, or something goes wrong and we have to devalue our currency. Then in that case, the inflation may take more time to come down. So it is very, very difficult, because now we are also part of the globe. We can't say that the India is not the part of the globe economy. So we have to also see relatively how the other countries are playing in the currency game also, because the way every country has started depreciating their currency, that is also a high risk. So if that is the case with India also, so far Reserve Bank of India has managed very, very nicely. Government of India is taking a lot of steps to deal with this foreign trades and all the thing. Even rupee trade has started. All these things are very, very positive, I think, for the country. But still, we cannot say that we are completely 100% out from that scenario. So still some level of risk is there, and that will decide the inflation trajectory. But as of today, it looks that peak has already been formed. And from here on, it will be downward trajectory. It may take some more time than everybody is expecting, but it looks positive. At least from our organization point of view, we are of the view that demand should be robust only in the coming time.
Got it, sir. Got it. I think we are running out of time now, so maybe I will request our audience to log in their questions. Mridul, can you please make the announcement?
Sure, sir. Dear participant, we invite you to pose your queries, please. You are requested to key in a panel in case of any queries. Thank you.
Yeah, so I think some questions are already keyed in. So the first question is for Mr. Revankar. How do you see the business outlook for asset-based financing, and which sub-segments are expected to do good?
As I was telling you, since the prices of the assets have improved and likely to improve with the inflation inside, so all the asset classes, I'm not very sure about the gold, but all other asset classes like vehicles, construction equipment, farming equipment, all are likely to be very good. So therefore, the earnings are good. The repayment capability is good. The resale values are good. So I think that's a very good part of the overall asset book.
Got it. I think there is one question for Mr. Ramachandran. It says that asset monetization, especially for hammer road assets, have slackened over the last few months, especially since the time interest rates have started hardening and impacting the viability thereof. In your view, will this dampen the credit demand for infrastructure and capex outlook, as the developer's equity is not free? I think basically what they're saying is that if the deals do not happen, because now the bank rate has gone up and the price, the valuation of the HAM assets goes up, in that case, the buyers may not be, and buyers as it is maybe expecting higher yield. So in the absence of those transactions happening, maybe the developers will not be able to free up their tied up equity in the commission projects. Deepak, any
Okay, so far at least I haven't come across anyone backing out of any of the committed deals, and we have been, been quite some time into this interest rate rising cycle, right? That has started somewhere. We've already gone through 4-5 months, and nobody is backing out of that. And typically, I would think, okay, at least I'm talking personally, but I would think most of these people who are in this market, they're all seasoned institutional investors. Nobody would have, underwritten a deal even at the height of COVID at say 6 or 7% interest rate. It's not, something which is normal, right? People would take into account that there are always cycles in any market. And that's something which is already inbuilt. So normal expectations in terms of changes, etc., I don't think is going to really do too much in terms of return expectations. They also will not change much despite it. Yes, when does it start happening and having an impact is when it goes beyond normal. Let's just to give an example. Tomorrow if interest rates from your current 6 to 8 or 9%, it goes to 15-16%. That's when it starts making a difference. 10-12% is also 10% also people will say, okay, maybe that is in the higher band of what the interest rate can be, because in any project you will have that band playing out. This thing. It's when it starts going way out of that band, that's when deals will start collapsing. I haven't seen any deal, anybody who was committed to a deal backing off so far. But then, time will tell how this is going to play out.
Got it. I've got one question which I think Mr. Savlani will be best suited for that. It says that, are you able to see more opportunities for Indian industry in this challenging global scenario wherein the Western world is the hardest hit and the growth in China is also impacted? I think somewhere maybe if I were to add a little bit here, there is a lot of conversation about China plus one, and India in a way with the current turmoil where, China kind of being a little out of full speed action. Could we, use that as an opportunity and maybe become a China plus one this thing? So over to you, sir.
Yeah, I think to some extent it is there. We can't say that it is not there. That now the soft cornering toward India is definitely there, and the way our government of India is working, and the way our foreign relationships are getting stronger and stronger with the countries, it looks that now world have started looking India as an alternate to China also, and to some extent they want to, I can say, de-risk themselves also, rather than depending on one country. They want to de-risk themselves, and some part may be diverted to India also. But at the same time, we have to also see that we have to develop our capabilities. The kind of capacity is there in the China. India needs many years to build up that kind of capacity. But yeah, definitely to some extent, we can capture their market share also. And that is going to help India. And the way government is, I think, working with the many countries, particularly the countries where we have a deficit of trade, there they are working with the rupee trade also, and they are negotiating hard and trying to export many products in that countries also. So that is also going to help the Indian economy on the export front. So we can't say that we are going to take the market share of China quickly, but definitely steps have been taken toward that direction. And to some extent, we have started working on that direction. If the government of India will work hard on that more, and then I think Indian corporates are quite capable to take that opportunity, but it will take many years to capture that, because that kind of capacity building in India will take years to build.
Right. I think that is very well said. While there is an opportunity, but we will have to, really work hard to be able to monetize that. I think that's it's easier said than done. Very true. We have a few more questions, but I think we are just on the dot at 4 o'clock, and I don't want to. All of you have busy schedules, so I will kind of, maybe we will just close it. A lot of thanks and wishes to all of you for the festive occasions coming through. And it was, good that you could take time out from your busy schedule and we could have this interesting conversation. Very interesting times. I think all of you will agree. Every day, reading a business paper has suddenly become a lot more exciting than it ever was. Every day something new is happening. So I wish you all very good. And Mridul, can we have just a final word of thanks, please?
Sure, sir. Thank you, sir. Thank you, Smita, for your presentation. And thank you again to all our guest speakers, Mr. Revankar, Mr. Ramachandran, Mr. Savlani, for your insightful views. It was a privilege hosting you, sir. And thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or comments, you're welcome to write to us in the feedback mail, which will be coming no sooner the webinar ends. I request the tech team to log off, please. Thank you and goodbye for now.
Thank you.
Thank you.
Thanks, everyone.
Thank you.